If you're retiring from FedEx with over $1 million in retirement savings, you're going to want to stick around. Wesley Boudreaux, one of our financial advisors here, is going to be showing you how to convert those savings into a lifelong paycheck that will last you throughout your lifetime. But first, hello, my name is Samantha and I'm going to be your moderator today. Stick around after Wesley's presentation and he'll also be answering some questions. You might be interested in listening to those answers. And lastly, I just want to remind you that we are not affiliated nor endorsed whatsoever by FedEx. The retirement group is a completely independent group of financial advisors, so please keep that in mind as you listen along. And without further ado, let's get this started with Wesley Boudreaux.
All right, thank you. Appreciate that introduction, Samantha. Like you said, we're going to be talking about what it's like as you transition from accumulation to distribution phases in retirement. How are you going to actually tap into that money? This is going to be kind of a high level, but obviously we will continue to discuss the fact that this is really a one-on-one conversation. So if you have questions, want to dig into how you can structure your specific portfolio, run a cash flow analysis, see if you're on path to meet your retirement goals, that's definitely what we need to take care of. But this should give you a high-level overview. Now, most of the companies we do work with, or most of the employees and retirees we work with, have worked at Fortune 500 companies, in which case they're going to probably have a 401k. And in some cases, they're lucky enough to still have a pension plan. There are some companies we work with that still have pension plans. And you got that option to take a lump sum or an annuity. We'll talk about the differences of annuities, touch a little bit on lump sums. But generally speaking, if you have kept your head down, saved for retirement, the biggest vehicle most of us have is going to be that 401k, where we're generally putting in pre-tax money. Meaning, let's say if you make $100,000 a year and you do a 10% contribution, you're putting in 10% or $10,000 each year. You get a tax deduction on that. So it looks like you only made $90,000 for that year. But eventually, down the road, when you decide to start taking withdrawals from that 401k or from an IRA, if you roll it over, you're going to be paying taxes on that. Now, a lot of times, the participants we work with tend to want to roll over their 401k to an IRA for a number of different reasons, but primarily because whether you're working with the retirement group, another firm, or doing it yourself, there's just a heck of a lot more choices. You go from maybe 10, 15, 20, 30 choices to over thousands of choices. Some reasons to actually stay in the 401k plan are if you're under the age 59 and a half, that's something to be aware of, or maybe you like simplicity, or there's a specific proprietary fund you like in there. Again, it's important to kind of review these options with an advisor and focus on a fiduciary that's going to go over the pros and cons and not just tell you roll everything over to an IRA. They want to understand what your 401k plan provides as well. So again, rolling over to an IRA, going back, traditional IRAs are pre-tax vehicles, in which case you make that contribution, get that tax deduction, and that plus the growth is all going to be tax deferred, eventually paying taxes on it. And then you're going to be forced to take out the RMD, the required minimum distribution, at age 73 or 75, depending upon how old you are when you were born. The Roth IRA, this is another vehicle where most of you may have taken advantage of this outside the 401k. It's been a couple years since they've instituted those within 401ks. But the difference there is if you make a contribution, you don't get that tax deduction, but the growth on that and what you put in is going to grow tax-free as long as you wait 5 years and wait until 59 and a half to tap into that. So that's one of the best investment vehicles around, and you don't have to do RMDs on there as well, at least for now. Obviously, Congress can change some of these things. Now, the biggest issue we run into, and I run into it day in and day out, as far as running a cash flow analysis or a financial plan for somebody, whether they've already retired or whether they're a couple years away from retirement, it's really truly understanding your budget and understanding what you're going to spend. I'm a control person and I don't have control over what you're going to spend. But to be honest with you, that's the framework of the entire cash flow analysis or entire financial plan. You need to understand what you're taking out. If you come in and say, hey, Wesley, I'm going to spend $7,000 a month for the rest of my life, but if we turn out and it looks like you're really spending $8,500, that could have a dire effect, and you could have a potential shortfall depending upon your situation. It also may be that your withdrawals are not just as simple as taking, $5,000 or $6,000 or $7,000 a month the rest of your life. They may be fluctuating withdrawals. My glasses aren't on, but in that picture I can see it looks like a house and a car. So that's a good example. A lot of times we may do what I call the rough draft of the financial plan. You might take a look at your budget. We can get over a simple budget plan to you, or even a detailed spreadsheet you can run in there and go through it on your own time. But you may come back to me and we say, okay, it's $6,000 a month is what we think we need to spend. We'll start the plan based upon that, but we can also back into how much can that plan support? and tell you what your max spending is. It might come out and say, well, you could actually spend $7,200 a month, or you can only spend $5,800 a month. So you need to either cut your spending or maybe work a little bit longer. We will not shy away from telling you if you need to work longer or if you need to reduce your spending, because we run these from a very conservative standpoint. But going back to that picture of the car and the house, it may be in that second iteration, or maybe even the first iteration, we talk about, well, okay, I'm spending $7,000 a month, but actually $1,500 of that is my mortgage, and it's going to be paid off in 10 years. So that 1,500 portion actually would not grow with inflation. Plus, it's going to drop off in 10 years. So that's another thing to be aware of. We want to be as concrete as possible with some of these distributions and budgets. You may want to buy a new car every 7 or 8 years. Maybe that's on top of what your regular spending is. Maybe you've got a wedding to plan for in the next 2 or 3 years. Maybe you want to spend an extra $10,000 on travel the first 10 or 15 years and then drop it down. We can go through all those different items, but the biggest homework for you guys is going to be figuring out that budget and trying to be as conservative as possible. Now, when it comes time to distributing those assets, again, you spent your entire career saving assets, and now you have to distribute those. There's a couple of different ways to focus on that. Number one, it's how do you actually invest those assets, and how do you create a potential income stream? There's a lot of different ways to go through it. We'll go over some of them high level, but like I said before, everybody's unique and specific, and it's really important to kind of sit down one-on-one and go through what you're trying to achieve and figure out which one's the best or which combination is the best. And then we got to layer in the taxes as well. We're not going to go into too much detail on this, but we do have other webinars that go into taxes. And there's the distribution strategy of how do I take it out so that I maximize what goes into my pocket versus Uncle Sam's. So a couple of items we're going to cover are going to be annuities, dividend stocks, interest from fixed income, whether it be bonds, CDs, short-term investments like money markets, simple portfolio diversification. This is typically what you're used to in your 401k, and it is what we do with a lot of clients on the managed accounts as well. And a newer one, managed payout mutual funds. I'll touch on that, but to be honest with you, I haven't seen those stick too well, and we'll touch on what those are as well. So let's jump into annuities. Now, let me just preface this. One of the most important things I can tell you is whether you want to look at an annuity or not, a lot of times they get a bad name, and I'm on the same board as that because a lot of times they are sold by insurance agents. So you want to make sure if you have any questions around an annuity, that you talk with a fiduciary that is going to be able to work in your best interest every step of the way. I'm not saying all insurance agents are bad, but a lot of times they may not have a choice. They may be captive to one company, so they only have one specific set of products they can sell. They're not licensed to do anything else but that. They may have, one specific product they like that they think is a one size fits all, and honestly, it's not. If somebody comes to me asking about an annuity, it may be that I could look at 50 and tell you there's only 2 or 3 that may make sense for you right now. And in 6 months, those 2 or 3 may not make sense. Something else may make sense. So it's very important to understand all the ins and outs and pros and cons to these before I kind of jump into them. Now, there's actually 4 kind of different ways to break this up. There's the income. It can be immediate, meaning you turn that income on pretty quickly, or deferred. You can let that sit there for another year, 10, 15 years. It's really up to you. And then there's also the way that they're either paid out or the way that they defer and the way they grow. They can be fixed or variable. So your payment can be fixed and locked in, doesn't grow with inflation, or it can be variable. It may be tied to the performance of the market with the cost of living adjustment on it. And then also if you defer that, if you wait to turn on income in a couple of years, the growth may either be fixed or it may be variable. It may go up and down depending upon what you pick and choose. But the simplest way to look at this on the immediate is going to be it's similar to like a pension. So if you're viewing the fact that, hey, I've got a pension that's going to pay me, $3,000 a month the rest of my life, it's not going to grow with inflation. That's kind of what a single premium immediate annuity is going to be. And we'll talk about that in just a moment. So one of the biggest issues with these or downside is that you could reduce the potential inheritance to your beneficiaries, especially on a single premium annuity. But we'll go into some different options you can have there. So like I said, one of the ones to kind of compare to a pension is a single premium immediate annuity. So let's say I retire from a firm and they're going to give me, let's say $3,000 a month the rest of my life, or I can take a lump sum of $600,000. So you may ask, Wesley, what's the best option for me? Really, it's good to actually go in there, run that cash flow analysis, look at those 2 options side by side. There's a number of different ways you can look at it. We can look at strictly that $3,000 a month pension for the rest of your life. How does that play out the next 20, 30, maybe 40 years even? Because it is going to pay for life. Are you able to do just a single life annuity? Are you able to do a joint survivor? Are you able to put a period certain on there so you get some money back if you pass away sooner? Or you may say, okay, I want to take that $600,000. I think I can invest it, maybe do more. So what's that? 600, 3,000 a month. That's a 36,000. So I'm close to about 6% return that you need in order to maintain that principal. But if you dip into the interest, you can have a lower return on there and still be okay. So it may be about 5% break even, something like that. We go out there and probably get you 5% in money markets right now, but we need to focus on the long term. So you may go and say, okay, well, interest rates have risen. What if I were to actually try and replicate this myself with my own single premium immediate annuity? And it may be that if we had this conversation a year or two ago, we saw a lot of times where people in this example might have been able to go and take that 600,000 and maybe get $3,500 a month instead of 3,000 a month. We'd have to run the numbers because they change based upon interest rates. But it may be that now instead of getting 3,000 a month, maybe you get $3,200 a month, and you might be able to do what's called a cash refund on there. So that way, God forbid something happens to you earlier. Let's say you die in 10 years. Whatever's left of that 600,000 still goes to your beneficiary. So that way, you're locking in that lump sum, getting that out. Or maybe that you say, hey, it only takes me, $550,000 in order to get that 3,000 a month. So now I've got extra 50,000 I can keep on hand for emergency expenses or for a cost of living adjustment. Or you might say, hey, Wesley, I don't need $3,000. I only need 2,000. So you're back into how much do I need to annuitize for 2,000. So there are different options to look at. But again, that's an immediate annuity. Think about it the easiest way. It's opposite of a mortgage. You're the bank in this case. In that example, you're giving them 600,000 for them to turn around and give you, $3,000 a month for the rest of your life. And then, like I said, you can also defer that. So you can set it up to maybe you retire and you want to take another job for 2 years. You defer that out for 2 years before it starts coming in. But those are the safest. You know exactly what you get, but typically it's not gonna move up with inflation unless you put a cost of living adjustment rider on it. But that does come with added cost. Now, the difference between a fixed index annuity and a variable annuity, these are going to typically be used more for the deferral side. We do see individuals use them for immediate income, typically more the fixed index annuities for immediate income because they tend to have a higher payout rate, at least right now. But what's going to happen is the difference between those, a fixed index annuity is going to give you protection, in which case you're not going to be exposed to the market on the downside. But with that protection comes some restrictions, if you would. You're going to be capped on what you could earn. Yes, it is tied to or mirrored an index, whether you pick the S&P 500, a EFA or Russell or something like that. It's going to move with that in conjunction. But typically what will happen is a fixed index annuity will have limitations on there. They may have a participation rate. They may say you only participate in 50% of the upside or 60% of the upside. They may have a cap rate, meaning you can't get more than 5% or 7% or 8% or something like that. When those two work in conjunction, those returns can be lower and typically closer to like a bond yield. So be very, very careful if somebody is talking to you, especially an insurance agent, saying, this can do what the market does. Either they're lying to you or they don't know what they're talking about. If I'm going to talk with you or if the retirement group's going to talk to you because you're coming to us because you're asking about annuity, not because we're pushing them, we're going to focus primarily on that income side of it and tell you on a guaranteed basis, this is what you can get for life. Hypothetically, yes, it could go higher, but chances are it may not because we have those different parameters or those companies have the parameters on there and they can kind of pull those levers to reduce some of that. So be very, very careful if you're looking at that. These are the ones you typically hear about touted on Saturday and Sundays on the radio. Variable annuities are a little bit different. The insurance company takes some of the risk off the table by letting you invest in mutual funds. Usually, think about like a 401k. You might have 15 or 20 or 50 different fund options, and you can invest in those. So your contract value can go up or down. Your guaranteed income value typically will stay the same. It may go up if the performance is better, but these tend to come with higher costs because of the investment strategies in them. And so there's definitely pros and cons to both these. So like I said, it's very important. Usually we talked about this webinar is focusing on income. It's usually good to run that cash flow analysis, find out what you're trying to achieve, look at the income, then back into some of these different choices. So again, before I wrap up on annuities, we're covering this because we get a lot of questions on those right now. If you're questioning income or looking at different options to protect yourself, make sure you talk with a fiduciary to go through that and make sure it's something that you're digging into and not somebody's inviting you to a seminar, kind of pushing or selling you annuities. So be very, very careful about that. All right, so enough of those. Let's get into some other different options we look at. One could be interest and dividend investing. We work with a lot of companies in the oil industry, so got a lot of clients that maybe retire from ExxonMobil or Chevron and just simply held a large chunk of their stock, their company stock, because it was generating pretty good dividends. They were comfortable with the volatility of the underlying company and the stock, and it may be that they're collecting a 5 or 6% yield or on those dividends at times, and then as the stock goes up, that yield starts to decline because the price has gone up. And we might find some different triggering events where we maybe liquidate out portions of it and look at other investment options. So again, there's different, there's not a one size fits all. You can actually change your investment philosophy or distribution philosophy along the way. So again, focus on quality companies that pay pretty good dividends. This was definitely something that was very beneficial the last couple of years when interest rates were low for bonds. Now with inflation the last 2 years, we're actually starting to finally see yield again in bonds. So you may also see using fixed income like bonds or CDs or money markets to generate interest that you can live off of. Money markets are actually over 5%. The yield curve is pretty flat right now, so everything's kind of at that point unless you go a little bit farther out on some of the bonds. Now, there is additional risk associated with that. You're going to have, inflation risk. So let's say if you bought a bond, 3 years ago and it was only paying 3% or 4%, and then fast forward, inflation went up. What happened was you would have seen a loss in that bond if you decide to sell it, because nobody wants a 3 or 4% bond when they can go out there and get a 5 or 6% bond. They're going to pay you a discount for that. So be very careful about that, especially when it comes to individual bond investing. I had a conversation with somebody about that the other day, letting them know about their portfolio. Truly, when you look at a bond portfolio, you need at least 100 holdings in there. And a lot of times mutual funds are going to have thousands of holdings because they're more diversified and they're constantly making changes to those. There's also the credit risk. So make sure you're focused on companies that are good and sound, because the company can pay you 5, 10, 15, 30%. But if they go default and go under, they're not paying you anything. So be very careful about that. And dividend variability, obviously, as the yield will decline if the performance goes well, but obviously you'll be rewarded on the performance side, and they're never guaranteed. We definitely saw that during the pandemic. Some companies trying to cut or eliminate their dividends altogether. So be very, very careful about that as well. Now, one of the ones that we tend to see most and what the retirement group focuses on a lot of times is going to be total return investing. So really just essentially a diversified portfolio. If we're looking at a managed portfolio, think about like your 401k. You're diversifying your allocation between stocks, bonds, CDs, short-term money markets, things like that. And you're going to figure out what's an appropriate allocation for yourself at this point in time. And that can change over time. You may be more aggressive while you're working and more conservative as you approach retirement or you're into retirement. And it may mean that we're going to also employ a tactical allocation shift. So maybe we go and have a conversation. You're comfortable with a 40% stock exposure, 60% fixed income and short term. But we have a market pullback, so maybe we take advantage of that and increase that up to 50-50 or something like that. So there are different deviations on there, but the ability there is you simply just kind of tell us, okay, what is the withdrawal rate I'm trying to achieve? We go back historically, most advisors and most academics will tell you that you need to look at a 4% withdrawal rate to maintain an account for 30 plus years. Some have come out and said, really it might need to be 3.75%. In some cases, if you have better performance, it can be higher than that. Or if you're saying, hey, I don't care about passing on a certain amount to my beneficiaries, I want to spend this down over 20 or 25 years, you might be able to take out more. So the flexibility there is that you can update or make changes to that portfolio. However, the risk there is that if you take out too much and you have market swings, this is where sequence of returns can come into play. So let's say if you were to retire in 2008, took out large withdrawals and the market dropped by 30%, then you could have immediately kind of knocked down your nest egg and run the risk of potentially running out of money sooner rather than later if you did not adjust your withdrawal strategy. So again, very important to understand that, but typically we clear through Charles Schwab. So you might say, okay, Wesley, I want to take out $3,000 net a month out of my account. We link it up to your bank, set up so it comes monthly or maybe twice a week or something like that. And then if you need something extra, you can tap in there and we just have that discussion around the withdrawal rate and what's the appropriate allocation for that. Another one that I'll be honest with you, I've never used, I've seen them, haven't seen too many people use them, but they're managed payout funds. It's kind of, I guess, would be an answer to those the age-based funds you see in 401ks where you don't do anything, you just put on cruise control. You tell them, hey, I'm going to retire in 2030. So they're going to allocate it more aggressive now, start getting more and more conservative as you get closer to 2030. But the flip side is, okay, I don't want to do anything. I just want something simple. So I might pick, one of the managed payout funds that might have a goal of paying out 4 or 5% return. And then it's the mutual fund company's responsibility to go in there and manage that portfolio to a diversified portfolio, like we just talked about, structured between stocks and bonds and CDs. And they're going to give you that fixed yield. However, again, that doesn't mean that the principal is guaranteed. It's going to fluctuate based upon the investments in there as well. And there's also tax issues associated with those as far as the way they trade them. So a lot of times these are only beneficial in IRA accounts. But I'll be honest with you, like I said, I've never used them, nor would I. But it's definitely something to be aware of that's out there now as well. So let's kind of go through an example. Again, like I said, there's no one size fits all solution to this. The goal is to really sit down with you, go through that cash flow analysis, find out what you're trying to achieve, and then back into what are some options and maybe give you a couple of choices. And you might say, okay, well, I like this one, or I like a combination of these, and we'll be happy to walk you through that. But we're not a one size fits all solution. We're not going to kind of strong arm you into one specific solution. So in this example, let's say we got a 65-year-old couple, same age, make it easy. They need about $5,000 a month, so fairly modest living. Need about $5,000 a month. They want to spend about $6,000, which is close to what they're spending right now. So I didn't mention this on the budget, but one of the things to be aware of is really kind of break down your budget to essential and discretionary spending. Think about what do you really need to live on. And a lot of times you want to make sure that that portion is met with guaranteed income, whether it's Social Security, annuity, a pension, combination of those. And then your discretionary can have a little bit more flexibility to it. So that's exactly what this couple is looking at. They want $6,000. Their Social Security between the two of them about $3,000, so pretty good there. They've already covered about half of what their wants are, so their gap's about $2,000 to $3,000, depending upon just the core spending versus the discretionary spending. They've done well over time through their 401ks, which they rolled over to their IRA a year or two ago. They've saved about $1 million. So in this case, it's not that hard of one to look at. They've done pretty well respective to what they're spending. They need to generate another $2,000 to $3,000 a month plus taxes in order to get to that $5,000 to $6,000 goal. The good news for them, since they're modest and they're only spending $5,000, if they were doing that on the federal tax bracket side, they probably wouldn't have any taxes, or maybe just a tiny bit when you factor in that the Social Security is not going to be taxed much at that level. Also, that they're going to get the standard deductions. If they're spending at $6,000, it might cost them $1,000 $2,000 in taxes. So not a huge issue here, but if you're spending more, then taxes become more of an issue here. But very simple napkin math. We look at it that $3,000, so $36,000 a year at $1 million, that's 3.6%. So it falls within that rate of the withdrawal rate we talked about, keeping it under 4%. This is a couple that actually, with that low of withdrawal rate, probably has the flexibility or freedom to be as conservative as they want or as aggressive as they want. So it really comes down to what are they trying to achieve. Usually there's something in between there. So let's look at a hypothetical example with them. So let's assume that they said, hey, look, we want to make sure that $5,000 a month is guaranteed. That's our biggest concern. We are pretty conservative. We don't want to take on too much risk. So maybe they're able to break down the portfolio and go and look at, okay, if we want guaranteed income, we don't need any bells and whistles. We don't want for future growth. We just want something like a pension because we didn't have that at our company. We go out there and we say, okay, well, based upon rates right now, it's going to take about $360,000 for you to have a guaranteed joint and survivor annuity with for $2,000 a month for the rest of your life. So they decide to do that. So that's what 36% of their account. They're taking that, they're guaranteeing. So now they've got that $3,000 Social Security plus a $2,000 pension. They got $5,000 a month set for life. Now, again, it does not move with inflation. The Social Security will have a cost limit adjustment, but the single premium annuity will not. Then they decide they just want to set aside $40,000 just in money market. That should cover the next 3 years or so, maybe a little bit more, a little bit less, or so of spending, depending upon what they do to fill that $1,000 gap. And that means there's about $600,000 left that they can simply diversify in a diversified approach or a managed account with the goal of trying to continue to grow that for themselves and their beneficiaries. But in reality, this is kind of like a buckets of money strategy where they don't have to, if they're focused on that 6,000, they don't even have to tap into this for a little bit over 3 years or so. So they can weather the storm if they see market volatility. It's not going to cause a knee-jerk reaction. But in this case, they're probably likely going to have something more moderate, conservative, maybe 35%, 40% stock exposure, because again, they're more conservative in a standpoint. Now, if they have less money, the same thing could be true. It's just going to mean that potentially they're going to have less of that $600,000 portfolio in order to allocate. But again, Based upon this, what we're doing is we're taking them from that 3.6% withdrawal rate down to guaranteeing that 2,000. Now that's what they have to take out on that 640 is only about 1.9%. So definitely a very, very manageable withdrawal rate, and so a lot more conservative than what they would have been otherwise. Now, it's also important to remember the taxes on this. Most of the time we're talking with you, you've got qualified money. It's going to be a 401k or an IRA. You may have some after-tax money in there, or you may have some Roth in there, but typically it's going to be pre-tax money and company match. So as you take withdrawals from here, it's going to be taxed at ordinary income. Depending upon your age, if you're under 59 and a half, you could have an additional 10% penalty on there. I mentioned before, sometimes it's good to stay in a 401k plan. That's one of the reasons there is if you retire at 55 or later, you can tap into your 401k without that 10% penalty. Whereas if you go to an IRA, you have to wait till 59 and a half or employ what's called a 72T. It gets a little more complicated, but we can do it. So that's another reason why I said be careful. Talk with a fiduciary. If you're between 55 and 59 and a half, and somebody's telling you to roll everything over to a 401k, from a 401k to an IRA, they may not have your best interest in their mind. They may be focused on trying to get those assets over and manage them instead. You may have after-tax contributions in there. Again, you may have put in money, didn't get tax deductions on it. So that portion that you put in will be tax-free. The growth on it, however, will be tax deferred and you'll pay taxes on it. You can tap into that cost basis if you want. But one of the best things if you don't need that is you can also roll that over to a Roth IRA. So now it starts growing tax deferred and tax free. Now, even if you're still working for a couple more years, we can take a look at your 401k. If you built up after tax, you may have the option to roll some of that over to a Roth IRA now and get that started sooner rather than later. And if you've had Roth contribution in the 401k, those are all going to be tax-free, both the contribution and the growth on there, as long as you wait until 59 and a half, taking that from the 401k or the IRA. And the other thing to kind of think about is as you kind of move along, eventually the IRS is going to come knock on the door and say, hey, we have to take some of this money out so we can tax you on it. Used to be 70 and a half was the age. The Secure Act came out in 2020. They moved it to 72. Then the Secure 2.0 moved it to 73 and 75. So it depends upon how old you are. You're either going to be already taking RMDs or your first RMD is going to be at 73. Or if you're born in 1960 or later, it's going to be at age 75 unless they make changes again down the road. So that's good news. They pushed out the deferral, so allow you to defer it longer, allows us to sit down with you, go through more tax planning strategies a little bit longer, especially Roth conversion strategies to minimize those RMDs in the future. We get into this more in our tax webinar. And then again, that RMD, you can withdraw more if you want. It's just you have to withdraw at least that. So if the IRS comes out and it runs a calculation, they take it 73, divided by 26.5 because they use a divisor. Roughly, it's about 4%, give or take, the first couple of years, and goes up from there. But let's say if you got $1 million and they tell you have to take out 40 grand, you have to take that out. If you don't, they can come back and penalize you on what you didn't take out. It used to be pretty high. It used to be 50% of what you didn't take out. That's now been changed to 25%. But if you get it corrected within 2 years, it's down to 10%. And if you can show a very reasonable, situation as to why you missed it, then it could be 0%. So again, be very careful about that. You can take out more, but you cannot take out less. And like I said, I've kind of, talked about this throughout the course of the webinar. All of this is kind of high level. It's really important to kind of look at this one-on-one from a personal standpoint. If you can spend about 10, 15 minutes with us, gathering some data, we can put together a pretty detailed cash flow analysis for you. Like I said before, we might have 2 iterations. Might have the rough draft that you might want to go and dig deeper once you see how it works and make some tweaks and changes to the budget, or look at different variables, maybe retiring sooner, retiring later, get a second job, doing different things. We can go through all those different options with you. But give us about 15 minutes, give us about a week to put that together, and we can sit down and go through a pretty detailed cash flow analysis with you to show if you're on the right track. And then at that point, then you can back into what are some good distribution strategies and investment strategies to look at. So with that, I'm going to wrap it up. Kind of remind everybody who the retirement group is. If you haven't been on one of our webinars or talked with us, we are an independent financial advisory firm that does focus on working with corporate employees, especially from Fortune 500 companies. We've been doing this for over 30 plus years. And a lot of times we work with you on pre-retirement and then post-retirement. We do have offices throughout the country, so rest assured you can sit down with somebody face-to-face. Potentially, you can also have conversations with us via web meetings or phone calls, whatever your preferred option is. A lot of our advisors focused on just a select few companies. So if you've got company-specific questions, we can probably answer those as well. That allows us to dig deeper into your benefits, whether it be the 401k, healthcare, retiree medical benefits, the pension, life insurance continuation, things like that. And ultimately, the best thing you can do is take us up on that complementary cash flow analysis I talked about kind of throughout this. There's no way to really kind of tell where you stand unless we run something like that in order to, at a minimum, verify what you think, but at a maximum, open your eyes and show you exactly what you're looking at and how to structure your portfolio going forward. So with that, hopefully I didn't take up too much of your time, but if you have questions, want to schedule a meeting with us, you can use these QR codes to get into our appointment calendars, or also get into our LinkedIn to follow along with us more and get updates on these webinars. But you can reach at 800-900-5867 or info@theretirementgroup.com. And I don't know, Samantha, do we have any questions during all that?
Yeah, actually, Wesley, we did get a couple questions. While Wesley's answering these questions, I want to remind you guys to pop open your chat window, and there's definitely some good resources in there that reference a lot of the things Wesley spoke about that you guys can take advantage of, including that complementary cash flow analysis that he mentioned. So, all right, Wesley, are you ready for a couple questions?
Yeah, sure.
Okay. Number one, can I still contribute to an IRA or 401k after retiring?
Yes and no. It's going to depend. So after you retire, you're not able to make contributions to an IRA or 401k unless you've got earned income. So you may retire and go, work at a Home Depot, work at a hardware store, go do something. Maybe open up your own company. But as long as you have some earned income, then yes, you can make contributions. It used to be that after 70 and a half, after the RMD age, you couldn't, but now that's been changed. So you can be 95 years old, a greeter at Walmart or something like that. As long as you've got earned income, you can make contributions to an IRA or potentially a 401k if that company allows your 401k.
All righty, thank you. Next one. Are annuities a safe option for retirement income?
Well, it's going to depend. Typically, they're considered the safest option, and depends upon what type of annuity. I know I kind of went through some of these. That's why it's important to really sit down, talk with a fiduciary to understand the pros and cons with them. If you compare just a simple one, like a single premium immediate annuity, which is really a comparison to what you'd see with a pension plan. If you retire from a company and they give you a certain amount a month for the rest of your life, the question becomes, what happens if that company goes under? The PBGC steps in and is supposed to protect you from there, but there are limits. An example would be back when Delta went through bankruptcy in 2000 or 2001, a lot of the pilots had their pension cut in half or cut by 20, 30, 40% because they hit the limits of the PBGC that stepped in. Now, a private annuity is going to go through an insurance company, which their responsibility is to pay you. But if they were to go under, then there's what's called a state guarantee fund, and there's limits on there as well. Most of them may be $250,000 or $300,000. Think about like FDIC insurance. But a lot of times, if an insurance company were to theoretically go under, most of the time another insurance company is going to come in and buy that policy out, so they avoid the black eye. But if you kind of go through all those options, there are some backstops in case. So a lot of times, if you're taking an income annuity, it may be beneficial if you just want extra security to split up maybe 2 or 3 different companies to protect you there. But generally speaking, they are viewed as the most safe because insurance companies have to keep so much cash on hand and have a different reserve than what even banks have in some cases. Now you get into, if you're doing variable investment annuities, then again, you've got investments in there that are tied to the market, so they're not as safe because it's going to fluctuate. Mm-hmm. So there's, again, no one size fits all. Just have us take a look at what you're looking at, and I'll give you kind of the ins and outs of it and the pros and cons.
All righty, thank you.
Mm-hmm.
Last one, Wesley. How should I approach withdrawing from my accounts in retirement?
Well, we kind of covered some of these as far
Definitely.
as breakdowns of maybe how to allocate the accounts. And again, it's really a one-on-one conversation to see what's the best for you. But I didn't go over a lot, maybe the distribution strategies as far as how and when to take that money out. Mm-hmm. So one of the downfalls, let's say if you retired, and let's go back to that example of the couple I had. Let's assume maybe they were in even better shape, and maybe they had $4,000 of Social Security, and they decided to turn on a pension of $4,000 a month from their company. So that's what 4 and 4. Now they got $8,000 a month of guaranteed income for the rest of their life, which sounds great, but they can't change that. So if tax brackets shoot up to 50%, they're getting taxed on it. Whereas in some cases, it may be more beneficial not to have everything tied up in fixed income or fixed guarantees because you don't have control of taxes. You may want to have some flexibility where you can pick and choose different years as tax brackets change to increase your distribution or decrease it. I talked again about Roth conversions. That's one big aspect we focus on because with all the government spending, they're going to have to either devalue the currency or they're going to have to raise taxes somewhere down the road. And once you get to that age 73 or 75 and you're forced to start taking money out, it is what it is. You can't control it. So if we can Slowly convert some of that year by year to Roth IRA so it grows tax-free for yourself and your beneficiaries. That's going to reduce what you have to take out later, so you've got more control of that. So it gets into really kind of tax planning. There's, again, not a one size fits all. Let's take a look at the cash flow analysis, talk about what's the investment strategy, where you can distribute these, and then how to distribute those as well.
All righty, Wesley, that was all we had time for today. Any last thoughts before we end?
No, I think I went longer than I expected. So
Okay.
again, we work with a lot of different companies. That doesn't mean we're employed by your company, but if you have any questions, just reach out to us at 800-900-5867. Thank you.
Thank you, everybody. Thanks for being here. We hope to see you on another webinar soon. Bye.